Before we begin, it's crucial to understand that I am not a licensed financial advisor, insurance professional, or attorney. This presentation is created for educational and informational purposes only and should not be considered professional financial or legal advice. The world of insurance is complex and varies by state and individual circumstances. Always consult with a qualified and licensed professional before making any decisions about your insurance coverage. There's a number you've probably never thought about. It's the number of dollars you will pay for car insurance over your lifetime. For the average American driver, that number is over $100,000. $100,000 for something you hope you never ever have to use. It's one of the biggest bills you'll pay year after year. Yet it's the one we understand the least. We treat it like a utility bill, we just pay it. We assume the person on the other end of the phone has our best interests at heart. We tick a box that says full coverage and pray it actually covers us fully when things go wrong. And that's the trap. A friend of mine, let's call him Alex, learned this the hard way. He was a safe driver, had a good job, and did what he thought was the responsible thing. He bought full coverage on his brand new car. He paid his bill on time every month for 3 years straight. Then one rainy Tuesday, he slid on a patch of oil and rear-ended a Mercedes. It wasn't a huge crash. No one was hurt, thank God. But the bumper, taillight, and trunk sensor on the Mercedes were damaged. Alex called his insurance confident. He had full coverage, right? A week later, he got the call. The repairs to the Mercedes were going to be $28,000. Alex's policy, the one he'd been paying for faithfully, only covered $25,000 in property damage. The insurance company paid their part, and then sent Alex a bill for the remaining $3,000. $3,000 out of his own pocket, because of one little number buried deep in a policy he never truly understood. He thought he was protected. In reality, he was just one small accident away from a financial nightmare. That story isn't an exception. It's the system working exactly as designed. Car insurance is a language, and it's a language that is intentionally confusing. It's filled with jargon, hidden clauses, and confusing numbers designed to do one thing: separate you from your money while providing the absolute minimum protection required by law. The insurance companies have armies of lawyers and actuaries. What do you have? You have this video. This is not going to be a boring lecture. This is your playbook. This is the decoder ring for the entire industry. Over the next 10 parts, we are going to tear down every single aspect of car insurance in the United States. My promise to you is simple. By the end of this series, you will not only understand what you're buying, you will know how to get the absolute best coverage for the lowest possible price. You will learn the questions to ask, the traps to avoid, and the secrets the insurance companies don't want you to know. You will be able to look at any policy and know with 100% confidence whether you are protected or exposed. You will stop guessing and start controlling one of the biggest expenses in your life. So let's start with the most basic question of all. Why do you even need this stuff? The first answer is simple: because it's the law. In 49 out of 50 states, you are legally required to have car insurance to drive on public roads. But the legal reason isn't the real reason. The real reason is to protect you from financial ruin. Think about it like this. Imagine you cause an accident. It's a bad one. You total a brand new $70,000 electric pickup truck, and the driver has to be airlifted to the hospital. The medical bills, the lost wages from them not being able to work, the physical therapy, plus the cost of their truck. You could easily be looking at a bill for $300,000, or $500,000, or more. Without insurance, that's your bill. The other party's lawyers will come after your bank accounts, your investments, your future paychecks, and potentially even your house. A single moment of distraction on the road could financially obliterate everything you've ever worked for, and everything you ever will work for. That is what insurance is for. It's a shield that stands between your life and financial catastrophe. So, how does this shield actually work? Well, every car insurance policy is built from a few key ingredients. Think of it like a pizza. You have to start with the dough and the sauce before you add any toppings. In the insurance world, the dough and sauce are called liability, collision, and comprehensive. Let's break them down. First up is liability coverage. This is the absolute bedrock of every policy because it's the part that's legally required. The easiest way to think about liability is this. It's the, "I'm sorry I wrecked your stuff and hurt you" insurance. It pays for the other person's car and the other person's medical bills when you are at fault for an accident. I'm going to repeat that because it's the most misunderstood part of insurance. Liability coverage does not pay a single penny to fix your car or to cover your medical bills. It is only for the people you hit. Liability is split into two parts: bodily injury and property damage. Bodily injury covers medical expenses, pain and suffering, and lost wages for the people you injure. Property damage covers the cost to repair or replace whatever you hit, whether it's their car, a mailbox, or a storefront. When you look at a policy, you'll see three numbers like 25/50/25. This looks like a secret code, but it's actually simple. The first number is the maximum amount. In thousands of dollars, your policy will pay for one single person's injuries. So 25 means $25,000. The second number is the maximum it will pay for all injuries in a single accident, combined. So 50 means $50,000. The third number is the maximum it will pay for all property damage. In this case, $25,000. That 25/50/25 line is the state-mandated minimum in many places. It's also the policy that got my friend Alex in trouble. One fender bender with a moderately nice car, and he blew right past his limit. Getting the state minimum is like wearing a paper helmet in a motorcycle race. You're technically following the rules, but you are not protected. Okay, so liability covers them. What covers you? That brings us to the second key ingredient: collision coverage. This one is simple. Collision pays to repair or replace your car if it's damaged in a collision with another object. That object is usually another car, but it also covers you if you back into a pole, hit a guardrail, or flip your car. If you are at fault, this is the coverage that fixes your ride. This is also where the word deductible comes into play. A deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays the rest. So if you have a $1,000 deductible and the repairs cost $8,000, you pay the first $1,000, and the insurance company covers the remaining $7,000. A higher deductible usually means a lower monthly payment, but it means you need to have more cash on hand if you get into an accident. It's a trade-off between monthly pain and potential future pain. The third and final core ingredient is comprehensive coverage. I call this the Acts of God and Idiots insurance. Comprehensive covers damage to your car from almost anything other than a collision. A tree branch falls on your car during a storm? That's comprehensive. A deer decides to play chicken with your front bumper on a country road? Comprehensive. Your car gets stolen? Vandalized? Caught in a hailstorm that makes it look like a golf ball? All comprehensive. It's the coverage for all the weird, unpredictable stuff life throws at your car. Like collision, it also comes with a deductible. So you have liability, which covers them. You have collision, which covers your car in a crash. And you have comprehensive, which covers your car from everything else. Those are the big three. So where does this magical term full coverage come from? Here's the first major secret the industry doesn't advertise. Full coverage is not a real insurance product. It doesn't exist. It's a marketing term. It's slang that has become so common that even agents use it. When someone says they have full coverage, what they almost always mean is that they have a policy that includes all three of those core components: liability, collision, and comprehensive. But calling it full is dangerously misleading. As Alex's story shows, you can have all three and still be massively underinsured. Your coverage is only as good as the limits and deductibles you choose for each part. Having full coverage with rock-bottom liability limits is like building a fortress with paper walls. It looks complete from a distance, but the moment it's tested, it collapses. You now understand the three fundamental building blocks of almost every car insurance policy in America. You know the difference between protecting them and protecting yourself. You know that full coverage is a myth. With just that, you are already miles ahead of most people on the road. But knowing what these coverages are is just the first step. The real question, the one that makes the difference between financial security and financial disaster, is how much of each do you actually need? Choosing the right numbers is the single most important and most commonly botched part of buying car insurance. And in the next part, we are going to build your perfect policy number by number so you are bulletproof without wasting a single dollar. So let's do it. Let's build your policy. Grab a coffee, pull up a chair, because this is where you go from being a potential victim of the insurance game to the person who actually understands the rules. When you look at a car insurance quote, the first thing you'll see is a string of numbers that looks like a secret code. Something like 25/50/25. This isn't random. This is the absolute core of your policy. It's called your liability coverage, and it has nothing to do with protecting you or your car. Not a thing. Liability coverage pays for the damage you do to other people and their property. Let's break down that code. 25/50/25. The first number, 25, stands for $25,000. This is the maximum amount your insurance company will pay for a single person's medical bills if you cause an accident. Let's say you run a red light and T-bone another car. The driver, a guy named Bob, breaks his leg. The ambulance ride, the ER visit, the surgery, the physical therapy, it all adds up. If Bob's total medical bill is $22,000, your insurance pays for it. You're good. But what if the accident is more serious? What if his bill is $40,000? Your insurance pays the first $25,000. And you? You are personally on the hook for the other $15,000. They can sue you for it. They can garnish your wages for it. That $15,000 debt will follow you around like a shadow. The second number, 50, stands for $50,000. This is the maximum total amount your insurance will pay for all medical bills for everyone you injure in a single accident, not counting yourself. Imagine that same accident, but this time Bob has his wife and kid in the car. Bob's bills are $30,000. His wife's are $25,000. His kids are $10,000. The grand total is $65,000. Your policy has a cap of $50,000 for the whole accident. Your insurance pays that $50,000, and you are now personally responsible for the remaining $15,000. Again, that's a lawsuit waiting to happen. The third number, the last 25, stands for $25,000. This is the maximum your policy will pay for all property damage you cause. This is usually the other person's car, but it could be anything. A mailbox, a storefront, a city fire hydrant. You think $25,000 sounds like a lot for a car? The average price of a new car in the United States is now over $48,000. So you glance at your phone for 1 second, swerve, and hit a brand new Ford Explorer. You've just totaled a vehicle worth twice what your insurance will pay. You are now on the hook for the other $23,000, plus the cost of their rental car while theirs is being replaced. Now, why did I use the numbers 25/50/25? Because in many states, that is the legal minimum amount of insurance you are required to have. And this is the single biggest trap in the entire industry. The state minimum is not a recommendation. It is not a suggestion of what is safe. It is the absolute bare minimum you can legally have to avoid getting a ticket and having your license suspended. Following the state minimum is like building a house to the absolute minimum safety code allowed. Sure, it's technically legal to live in, but you wouldn't want to be inside during a stiff breeze. A single moderate accident with state minimum coverage can lead to financial ruin. It can wipe out your savings, force you to sell assets, and put you in debt for years. Medical costs are astronomical. A single airlift can cost over $50,000. An overnight hospital stay can be $10,000. The cost to repair modern cars with all their sensors and computers is shocking. A simple fender bender can easily top $5,000. Your state minimum $25,000 in property damage doesn't stand a chance against a multi-car pileup or an accident involving a new Mercedes or a Tesla. So what numbers should you have? Let me give you a simple framework. I call it good, better, and bulletproof. Good coverage is 50/100/50. $50,000 for one person, $100,000 total for medical, and $50,000 for property damage. This is the absolute floor I would recommend for anyone. If you're a student just starting out with very few assets to your name, this level of coverage provides a basic, respectable layer of protection against a common accident. It gets you out of the danger zone of state minimums. Better coverage is 100/300/100. $100,000 for one person, $300,000 total for medical, and $100,000 for property damage. For the vast majority of people, this is the sweet spot. This is the best bang for your buck. The price jump from 50/100/50 to 100/300/100 is often surprisingly small, maybe $10 to $20 a month, but the leap in protection is massive. This level of coverage can handle a serious multi-car accident. It can handle severe injuries. It protects you from 99% of the situations you're likely to encounter on the road. It means you can sleep at night knowing that one mistake won't bankrupt you. That $100,000 in property damage means you can total a brand new BMW, and your insurance will cover it. Finally, we have bulletproof coverage. This is typically $250,500/100, $250,000 for one person, $500,000 total for medical, and $100,000 for property damage. Who needs this? Anyone who owns a home. Anyone with significant savings or investments. Why? Because if you have assets, you are a target. If you cause a catastrophic accident and your 100-300 limits are exhausted, a lawyer for the injured party won't just shrug their shoulders. They will look at what you own. They will see your house, your 401k, your savings. They will come after everything you've worked for. Bulletproof coverage is about protecting your assets. It puts up a massive financial wall that says, "Don't even think about suing me, because my insurance company has very, very deep pockets and will handle this." Okay, so we've just protected the rest of the world from you. But what about protecting you from the rest of the world? There's another set of numbers on your policy that is just as critical, and it's called uninsured and underinsured motorist coverage, or UM/UIM. The statistics are terrifying. In some states, as many as 1 in 4 drivers on the road has no insurance at all. 0. And even more have the laughable state minimums we just talked about. So what happens when one of them runs a stop sign and plows into you? Their insurance is either non-existent or so pathetic it can't even cover the ambulance ride. You're the victim, it's not your fault, but you're left with a mountain of medical bills, you can't work so you're losing income, and the person who hit you has no money and no coverage. You're stuck. Unless you have uninsured motorist coverage. This is insurance you buy to protect yourself from the irresponsible. It steps in and acts like the at-fault driver's insurance. Pays for your medical bills. Pays for your lost wages. Pays for your pain and suffering. Underinsured motorist coverage is similar. It kicks in when the person who hits you has insurance, but their liability limits are too low to cover your bills. Let's say your medical bills are $80,000. The guy who hit you has a state minimum policy that only covers $25,000. His insurance pays that $25,000, and then your underinsured motorist coverage can step in to pay the remaining $55,000. So what numbers should you get for this? The rule here is incredibly simple. You should always match your uninsured and underinsured motorist coverage to your liability coverage. Exactly. If you chose the better plan of 100/300 for liability, you get 100/300 for UM/UIM. If you chose the bulletproof 250/500, you get 250/500 for UM/UIM. Think about it logically. If you believe you are capable of causing $100,000 in medical damage to someone else, then you must believe someone else is capable of causing that same amount of damage to you. Protecting yourself should be just as important as protecting a stranger. This coverage is usually very inexpensive, and skipping it or cheaping out on it is one of the most reckless gambles you can make. So now we've built the foundation. We've protected other people from you with strong liability coverage. And we've protected ourselves from other people with matching uninsured motorist coverage. We've handled the people. But there's still one giant expensive piece of the puzzle missing. What about the car itself? Your car. What happens if a tree falls on it in a storm? What happens if you back into a pole? What happens if it gets stolen from your driveway? None of the coverages we've talked about so far will pay you a single dime to fix or replace your own vehicle. For that, you need 2 completely different types of coverage. And they are, without question, the 2 that people confuse the most. They are collision coverage and comprehensive coverage. Let's break them down right now, because understanding the difference is the key to not getting ripped off, and to making sure your single biggest investment after your home is actually protected. Let's start with collision. The name is pretty straightforward. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. Notice I said another object. That's the key. It could be another car, a telephone pole, a guardrail, a fire hydrant, or the garage door you thought was open. If you hit something, collision is your hero. Here's a scenario. You're at the grocery store, backing out of a tight parking spot. You're checking your mirrors, you're turning your head, but you don't see that short, yellow concrete pillar. Crunch. That sickening sound of metal bending. You get out, and there's a nasty dent and scrape all down your rear bumper. The damage is going to be over $1,000 to fix. Who pays for that? Your collision coverage pays for that. And here's the most important thing to understand about collision. It pays regardless of who is at fault. You backed into the pole? You're covered. You slide on some black ice and hit a tree? You're covered. Someone else runs a red light and plows into the side of your car? You are absolutely covered. Now, in that last case, your insurance company will likely go after the at-fault driver's insurance to get their money back, but you don't have to wait for that legal battle. Your collision coverage is there to get your car fixed and get you back on the road right away. It's your immediate safety net. But there's a catch. And it's a big one. It's called the deductible. The deductible is the amount of money you have to pay out of your own pocket for a repair before the insurance company pays a single cent. Think of it as your share of the cost. Deductibles for collision coverage are typically set at amounts like $250, $500, or $1,000. Let's go back to that parking lot poll. The body shop gives you an estimate for $1,500 to fix your bumper. If you have a $500 deductible, you pay the first $500. Your insurance company then pays the remaining $1,000. If the damage was only $400, you'd pay the whole thing yourself because it's less than your deductible. You wouldn't even file a claim. Choosing your deductible is one of the biggest decisions you'll make. Here's the simple rule. A higher deductible means a lower monthly premium. A lower deductible means a higher monthly premium. You're essentially making a bet. Are you willing to pay more each month for the peace of mind that a repair will cost you less out of pocket? Or would you rather save money every month and be prepared to pay a larger lump sum if an accident happens? There's no right answer. It's about your personal budget and your tolerance for risk. So that's collision. Covers you when you hit things. Simple enough. But what about all the other horrible things that can happen to a car? What if a tree branch falls on it during a windstorm? What if you walk out of the mall to find your window smashed and your stereo gone? What if you hit a deer on a dark country road? None of those are covered by collision. For that, you need its partner, comprehensive coverage. And right away we have to clear something up. The name comprehensive is probably the most misleading name in the entire insurance industry. It sounds like it covers everything, right? Like it's comprehensive. It is not. Don't ever fall into that trap. Here's a better way to think about it. Comprehensive coverage is sometimes called other than collision coverage. It pays for damage to your car from almost everything except a collision. It's for all the random, unpredictable acts of God type events. Think of it as the bad luck protection plan. Comprehensive covers theft. Your car gets stolen from your driveway. Vandalism. Someone keys your car or slashes your tires. Fire. An engine fire or your garage burns down. Natural disasters. A hailstorm makes your car's roof look like a golf ball. A flood sweeps it away. Tree falls on it. Hitting an animal. This is a big one people get wrong. Hitting a deer is not a collision claim. It's a comprehensive claim. Falling objects. That tree branch or debris falling off a construction site. And glass damage. A rock gets kicked up by a truck on the highway and cracks your windshield. That's a comprehensive claim. Just like collision, comprehensive coverage has a deductible. It works the exact same way. If a thief smashes your window and it costs $800 to replace, and you have a $250 comprehensive deductible, you pay $250, and your insurance pays the other $550. You can even have different deductible amounts for each coverage. You might choose a $500 deductible for collision, but a lower $100 deductible for comprehensive, because things like windshield cracks are much more common. So now you see how they work together. Collision is for when your car hits an object. Comprehensive is for when an object hits your car, or for when it's stolen or vandalized. One protects you from your driving mistakes, the other protects you from the world's bad luck. When you have liability coverage plus collision plus comprehensive, that's what people are usually talking about when they use the slang term full coverage. But please remember this, full coverage is not a real insurance product. It's just a shorthand way of saying you have the big three. It does not mean you're covered for literally every possible thing that could ever happen. There are still major gaps, which we'll talk about later. So, do you actually need collision and comprehensive? Unlike liability insurance, which is required by law, these two are often optional. But there's a huge exception. If you have a loan on your car, or if you're leasing it, the bank or leasing company will absolutely require you to have both. And they'll probably dictate the maximum deductible you're allowed to have, usually $500 or $1,000. Why? Because until you pay it off, the car isn't really yours. It's their asset. They are protecting their investment from being wrecked or stolen before you've finished paying for it. But what if you own your car outright? What if you're driving a 12-year-old Honda that's fully paid off? Should you still pay for collision and comprehensive? This is where you have to do some simple math and be honest with yourself. Insurance companies don't pay to replace your car with a brand new one. They pay you what your car was worth 1 second before the accident happened. This is called its actual cash value, or ACV. It's the sticker price minus depreciation for age, mileage, and wear and tear. So, your beloved 12-year-old Honda might be priceless to you, but its actual cash value on the open market might only be $4,000. Now look at your insurance bill. Let's say the portion for collision and comprehensive costs you $700 per year, and you have a $500 deductible. This means you're paying $700 a year to protect an asset that, in a total loss scenario, would only get you a check for $3,500. That's the $4,000 value minus your $500 deductible. Is that worth it? For some people, yes. They couldn't afford to suddenly buy a $4,000 car if theirs was totaled. For others, no. They'd rather save that $700 a year, put it in the bank, and accept the risk that they might have to replace the car on their own dime. A good rule of thumb many people use is this. If your annual premium for collision and comprehensive is more than 10% of your car's value, it might be time to consider dropping them. So now we've covered your legal responsibility for damage you cause to others, and we've covered how to pay for damage to your own car. We've protected property. But what about people? What about the single most valuable thing involved in any car accident? Your body. Your health. If you get hurt, who pays those astronomical medical bills? Who covers your lost wages when you can't work? The answer is far more complex than you think. It involves coverages with names like MedPay and personal injury protection, and in many states it forces you into a controversial system called no-fault insurance. We're going to break down exactly how to protect your health and your wallet from a devastating injury in the very next part. So let's play out that nightmare scenario. You're in a crash. It's not a fender bender. It's serious. The first thing you feel isn't worry about your car. It's a sharp, searing pain. An ambulance arrives. You're rushed to the emergency room. The doctors and nurses do their incredible work, but as the adrenaline wears off, a new kind of fear sets in. Who is paying for this? The ambulance ride alone can cost over $1,000. Bar visit? Thousands more. What if you need surgery? Physical therapy? What if you can't work for the next 6 weeks? This is where the game changes. We're no longer talking about fixing a bumper. We're talking about fixing a human being. And your policy has two potential heroes that can step in to handle this, depending on what state you live in: medical payments coverage, often called MedPay, and personal injury protection, universally known as PIP. Let's start with the simpler one, MedPay. Think of MedPay as a dedicated, fast-acting first aid kit for your wallet. It's an optional coverage in most states, and its job is simple: to pay for reasonable and necessary medical expenses for you and anyone in your car who gets injured in an accident. The single most important phrase to remember about MedPay is, regardless of fault. It doesn't matter if you caused the crash, if the other driver did, or if a deer jumped in front of your car. If you are hurt, MedPay kicks in immediately to cover the bills. This is huge. Normally, after an accident, there's a long, drawn-out process where insurance companies investigate to figure out who's at fault before any money changes hands. That can take weeks, even months. Meanwhile, the hospital wants its money now. MedPay bypasses all of that. It's your money for your injuries right away. It covers things like doctor visits, hospital stays, surgery, x-rays, and even ambulance fees and dental work if your teeth are damaged in the crash. And here's a key benefit most people overlook. MedPay can pay your health insurance deductible. Let's say you have a great health insurance plan, but it has a $4,000 deductible you have to pay out of pocket before it covers anything. A trip to the ER could easily hit that. If you have $5,000 in MedPay coverage, it can pay that deductible for you, meaning you pay nothing out of pocket. It also protects your passengers. If you're driving your friends to lunch and get into an accident, your MedPay can cover their immediate medical bills, which can save a friendship and prevent a very awkward, complicated situation. But MedPay has its limits. It only covers medical bills. It does not cover lost wages if you can't work. And it doesn't cover things like hiring someone to help around the house while you recover. It's a fantastic financial bandage, but it's not a full recovery plan. For that, you need its bigger, more powerful, and far more complex sibling, personal injury protection, or PIP. If MedPay is a first aid kit, PIP is a full-on trauma center. It's required in about a dozen states, and it's the foundation of that no-fault system we mentioned. First, let's talk about what it covers. PIP includes everything MedPay does: your medical bills, your passengers' medical bills, regardless of fault. But then it goes so much further. The most critical addition is lost wages. Imagine you break your leg and you're a construction worker, a waitress, or an Uber driver. You're out of work for 2 months. Your regular bills don't stop. Rent is still due, groceries still need to be bought. This is where an accident can spiral into a full-blown financial catastrophe. PIP steps in and can pay a percentage of your lost income, often up to 80%, while you recover. This is a lifeline. It can be the difference between a tough recovery and a personal bankruptcy. And it doesn't stop there. PIP can also cover what are called essential services. Say you're a single parent and you're too injured to take care of your kids or clean your house. PIP can help pay for childcare or a cleaning service. It is designed not just to heal your body, but to keep your life from falling apart while you do. So, if PIP is so amazing, why doesn't every state have it? Because it comes with a massive trade-off. This is the no-fault system. In a traditional at-fault state, if someone hits you, you go after their insurance, specifically their bodily injury liability coverage, to pay for your medical bills, lost wages, and your pain and suffering. It often involves lawyers and a lengthy fight to prove the other person was 100% to blame. The states with mandatory PIP decided this system was too slow, too expensive, and clogged up the courts. So they made a deal. The no-fault law basically says, forget about who caused the crash for a minute. If you're injured, you will use your own PIP coverage first to pay for your own medical bills and lost wages. Your insurance pays for you, their insurance pays for them. It's faster, it's more efficient, and it gets money into the hands of injured people quickly without having to wait for a fault determination. But here's the controversial part of that deal. In exchange for this quick, guaranteed payout from your own policy, you give up some of your right to sue the other driver. In a no-fault state, you generally cannot sue the at-fault driver for pain and suffering unless your injuries meet a certain threshold. This threshold varies by state, but it's usually defined in one of two ways. It could be a monetary threshold, meaning your medical bills have to exceed a certain amount, say $5,000. Or it could be a verbal threshold, which is more common, where you must have suffered a specific type of serious injury like a significant disfigurement, a broken bone, or a permanent disability. If your injuries are minor like whiplash or bad bruises, you're expected to just use your PIP benefits and move on. You can't sue the guy who ran the red light for the emotional distress and physical pain he caused you. Proponents say this stops frivolous lawsuits for minor injuries. Critics say it prevents genuinely hurt people from getting the full compensation they deserve. It's a fundamental debate about speed versus justice. So, how do you navigate this? First, know your state. Are you in a no-fault state where PIP is mandatory? Or are you in an at-fault state where MedPay is an optional but highly recommended add-on? If you're in a no-fault state, you have to buy PIP. The state sets a minimum amount, but this is one of the worst places to cheap out on your policy. The state minimum might be just $10,000 or $15,000. A single night in the hospital after a serious surgery can cost more than that. You need to look at your own life. How much is your health insurance deductible? How much income would you lose if you were out of work for 3 months? Your PIP limit should be high enough to cover that worst-case scenario. If you're in an at-fault state, you likely have the option to add MedPay. And you absolutely should. For just a few extra dollars a month, you can buy $5,000 or $10,000 in coverage. That's enough to cover most health insurance deductibles and copays, ensuring that an accident doesn't cost you a single cent out of pocket for your medical care. It provides incredible peace of mind for a very low cost. The bottom line is this: liability coverage protects other people from you, but MedPay and PIP protect you and your family from the devastating financial fallout of an injury. They ensure that your focus after a crash can be on your physical recovery, not on the mountain of bills piling up on your kitchen table. You've now covered your car with collision and comprehensive. You've covered your own body with MedPay or PIP. But we still haven't touched the single biggest financial risk you take every time you get behind the wheel. It's the one that can lead to million-dollar lawsuits, garnished wages for the rest of your life, and total financial ruin. What happens when the person you hit is a surgeon who can no longer perform surgery? What happens when their medical bills are astronomical? Your policy has a number for that, and it's the most important number in your entire insurance portfolio. That number is your liability limit, and it's almost always written as 3 numbers separated by slashes. You've seen it on your insurance quotes: 25/50/25, or 50/100/50, or maybe 250/500/100. It looks like a secret code, but understanding these 3 numbers is the key to protecting your entire financial life. This isn't just car insurance jargon. This is the firewall between a bad day and a decade of financial ruin. Let's break it down number by number. The first number is the bodily injury liability limit per person. This is the maximum amount your insurance company will pay for a single person's injuries in an accident that you cause. Let's go back to our surgeon. You run a red light and T-bone their car. They suffer a severe hand injury and require emergency surgery, a hospital stay, and months of physical therapy. Your policy has a 25 as the first number. That means your insurance will pay a maximum of $25,000 for that surgeon's medical bills. Now, does $25,000 sound like a lot of money? It is. But a single night in a U.S. hospital can cost thousands. A complex surgery can easily be $50,000 or $100,000. Add in ambulance rides, diagnostics, follow-up appointments, and rehabilitation. That $25,000 limit that seems so solid evaporates in an instant. If the surgeon's medical bills total $125,000, your insurance pays the first $25,000. Guess who gets the bill for the remaining $100,000? You. And we haven't even talked about the biggest cost yet. Their lost income. Because they can't perform surgery, they're losing hundreds of thousands, maybe millions in potential earnings. Their lawyer isn't just coming for the $100,000 in medical bills. They're coming for everything. This is why state minimums are so terrifyingly dangerous. In some states, the minimum required bodily injury limit is just $15,000. Think about that. $15,000. That might not even cover the cost of the initial emergency room visit for a serious injury. Choosing the state minimum is like trying to stop a tidal wave with a paper towel. Now for the second number. This is the bodily injury liability limit per accident. This is the absolute maximum your policy will pay for all injuries combined in a single accident you cause. Let's say your limits are 50/100. The 50 means you have $50,000 of coverage per person. The 100 means you have a $100,000 total cap for the entire accident. Imagine you're driving on a rainy evening, you hydroplane, and you swerve into a minivan carrying a family of 4. The father breaks his leg, the mother has a severe concussion, and one of the children has a broken arm. Let's say the father's bills are $40,000, the mother's are $50,000, and the child's are $10,000. That's a total of $100,000. All 3 individual claims are below your $50,000 per person limit, so that's good. And the total is exactly your $100,000 per accident limit. Your insurance pays the full amount. You're stressed, but you're covered. But what if the mother's injuries were worse? What if her bills were $70,000 instead of $50,000? Now we have a problem. Your per person limit is $50,000. So, your insurance will only pay $50,000 of her $70,000 bill. You are now personally on the hook for the other $20,000. On top of that, the total medical bills for the family are now $120,000. Your per accident limit is $100,000. So even after paying the max for each person, your insurance company will stop paying once the total hits $100,000. You are responsible for the rest. One accident, one family, and you could be facing a lawsuit for tens of thousands of dollars that you have to pay out of your own pocket. This brings us to the third and final number. Property damage liability. This is the maximum your insurance will pay for any property you damage in an at-fault accident. This is mostly for other people's cars, but it also covers mailboxes, fences, streetlights, fire hydrants, or even the front of a building if you crash into it. Years ago, a $25,000 limit for property damage was probably fine. The average car was much cheaper. But today, the average price of a new car in the United States is hovering around $50,000. You glance at your phone for 2 seconds and rear-end a brand new Ford F-150 or a Tesla Model 3. You've just totaled a $50,000 vehicle. If your property damage limit is $25,000, your insurance writes a check for $25,000, wishes you the best of luck, and walks away. The other driver's insurance company will then pay to fix their client's car. And then their lawyers will come after you personally for the $25,000 they had to pay out. And what if it's a multi-car accident? You cause a chain reaction on the freeway. You hit one car, which hits another, which hits another. You've just damaged 3 vehicles. A $50,000 SUV, a $40,000 sedan, and a $60,000 electric vehicle. That's $150,000 in property damage. If your limit is $50,000, you are personally facing a lawsuit for the other $100,000. This is the hidden nightmare of being underinsured. When the damage you cause exceeds your policy limits, the story doesn't just end. The other party's insurance company, or the individuals themselves, will sue you to recover the difference. And they will win. This isn't a maybe. It's a certainty. And when they get a judgment against you, they have incredible power. They can go after your bank accounts, draining your savings and checking. They can put a lien on your house, meaning you can't sell it without paying them first. They can seize your non-essential assets. And worst of all, they can garnish your wages. A court can order your employer to take a percentage of your paycheck, every single paycheck, and send it directly to the person you owe for years or even decades until the debt is paid. Imagine losing 25% of your income for the next 10 years. Forget saving for a down payment. Forget investing for retirement. Forget family vacations. Your financial future is held hostage by a single mistake, all because you tried to save $15 a month on your car insurance premium. So, how much liability coverage do you actually need? The answer isn't the state minimum. The answer is, you need enough to protect your assets and your future earnings. A good rule of thumb is to have liability coverage that is at least equal to your net worth. Your net worth is simply everything you own minus everything you owe. Add up the value of your savings, your investments, your home equity, your cars. Then subtract your mortgage, your car loan, your student debt. That number is your net worth. If you have a net worth of $200,000, you need at least that much in liability coverage because that's what you stand to lose in a lawsuit. But it's not just about what you have now. It's about what you will have. If you're a 25-year-old medical student with a negative net worth because of student loans, you might think you don't need much coverage. You're wrong. A lawyer suing you doesn't see your current bank account. They see your future lifetime earning potential as a doctor. They will sue you for that future, and a wage garnishment will follow you for your entire career. So let's get practical. For most people, a good solid starting point for liability limits is 100/300/100. That's 100,000 for bodily injury per person, 300,000 per accident, and 100,000 for property damage. This provides a respectable level of protection that covers the vast majority of accidents. If you own a home, have significant savings, or are a high-income earner, you should be looking at 250/500/100 as your absolute minimum. This level of coverage ensures that even a very serious accident is unlikely to breach your policy limits and threaten your personal assets. The cost difference between state minimums and these much safer levels is often shockingly small. We're talking about the price of a few cups of coffee a month. It is, without a doubt, the single best investment you can make in your financial security, because liability coverage isn't really about fixing cars. It's about protecting your life's work. It's the invisible shield that protects your home, your savings, and your family's future from being shattered by one moment of bad luck. And for those who have built up even more, or for those who simply want the ultimate peace of mind, there's another layer of protection that sits on top of all of this. It's called an umbrella policy, and it's one of the best-kept secrets in personal finance. So what is this secret weapon? Imagine you're standing outside and it starts to rain. Your regular car insurance policy is like a good solid jacket. It protects you from a normal shower. Your homeowner's policy is another jacket, protecting you when you're at home. But what happens when it's not a shower? What happens when a full-blown catastrophic hurricane hits? Your jackets are soaked through in seconds. You're completely exposed. An umbrella policy is a giant, reinforced, industrial-strength umbrella that covers you, your car insurance jacket, your home insurance jacket, and everything else you own. It's a separate insurance policy that provides an extra layer of liability protection, typically $1 million or more, that kicks in only after the liability limits on your other policies, like your auto or homeowner's insurance, have been completely exhausted. It's your defense against the financial hurricanes of life. And these hurricanes can strike anyone, at any time without warning. Let me tell you a story about a guy we'll call David. David is a good guy. He's 45 years old, an accountant, married with 2 kids in high school. He's done everything right. He's got a nice house in the suburbs, 2 reliable cars, a healthy 401k, and some college savings put away for the kids. He's a responsible driver. He has a good auto insurance policy with liability limits of $250/500/100. He feels safe. He feels covered. One Tuesday afternoon, he's driving home from work. It's a route he's driven 1,000 times. He's stopped at a red light, waiting to make a left turn. His phone, which is in a cradle on the dash, buzzes with a notification. The light turns green. As he starts to pull into the intersection, he glances at the phone for just 1 second, a single fleeting second, to see a message from his wife. In that 1 second, he doesn't see the motorcyclist coming through the intersection from the other direction. The impact is devastating. The motorcyclist, a renowned surgeon in her late 30s, survives, but her injuries are life-altering. Multiple surgeries, months of rehabilitation, and a permanent injury to her right hand mean she will never operate again. Her career is over. The medical bills alone climb past $500,000. And then comes the lawsuit. It's not just for the medical bills. It's for her lost income, the millions she would have earned over the rest of her surgical career. It's for pain and suffering. The final judgment against David comes in at $2 million. $2 million. Now let's see what happens. David's good, responsible auto insurance policy kicks in. His insurer pays out the maximum amount for a single person's bodily injury, $250,000. And that's it. That's where his auto insurance stops. He is now personally, legally on the hook for the remaining $1,750,000. Think about that number. The other driver's lawyers start the process of collecting that debt. They place a lien on his house. They go after his savings accounts, his investment portfolio, the college funds he so carefully built for his kids. They file for a wage garnishment, meaning a significant chunk of his paycheck will be taken every single month for decades to come. His life and his family's future, the one he so carefully constructed, is shattered. All because of a 1-second glance at a phone. He did everything he thought was right, but in the face of a financial hurricane, his jacket just wasn't enough. Now let's rewind that story. Let's change one single fact. Let's say that a year earlier, David's insurance agent had convinced him to add a $1 million umbrella policy to his portfolio. The accident happens. The lawsuit happens. The $2 million judgment happens. His auto insurance pays its full $250,000 limit. But instead of financial ruin, something else happens. The umbrella policy activates. It sees the remaining $1.75 million bill, and it covers the next $1 million of it. David is still responsible for the final $750,000, a lot of money, but a manageable amount compared to the alternative. He might have to take out a loan or restructure his finances, but his house is safe. His retirement is safe. His kids will still go to college. His life is not over. That is the power of an umbrella policy. It is the firewall between a terrible accident and total financial annihilation. So who needs one? The biggest misconception is that umbrella policies are only for millionaires with yachts and mansions. That is completely wrong. The real question isn't, how rich are you? The real question is, what do you have to lose? If your net worth, meaning your assets like home equity, savings, and investments minus your debts, is greater than your auto and home liability limits, you need an umbrella policy. If you have a $250,000 liability limit on your car insurance, but you have $400,000 in home equity and retirement savings, you have a $150,000 gap that lawyers see as a target. Ask yourself these questions. Do you own a home? Do you have a 401k or an IRA? Do you have a savings account with more than a few $1,000s in it? Do you have teenage drivers in your house, who statistically are at a much higher risk of causing a serious accident? Do you have things on your property that could increase risk, like a swimming pool, a trampoline, or even a dog? Do you coach your kids' soccer team, serve on a nonprofit board, or volunteer in a way that could expose you to liability? Do you ever post reviews online or have strong opinions on social media? Because an umbrella policy doesn't just cover car accidents. It also provides coverage for things your other policies don't. Like if you're sued for libel because of a negative online review, or if a guest slips and falls at your backyard barbecue. If you answered yes to almost any of these questions, you are a candidate for an umbrella policy. Now, you're probably thinking this kind of $1 million protection must cost a fortune. This is the most shocking part. For most people, a $1 million umbrella policy costs between $150 and $300 per year. That's it. We're talking about $15 to $25 a month. Less than the cost of a couple of lattes or your Netflix subscription. For the price of a pizza once a month, you can buy a $1 million shield that protects your entire financial life. There is arguably no better bargain in the entire world of insurance. The peace of mind alone is worth 10 times the cost. So how do you get one? It's incredibly simple. First, you'll almost always need to have your auto and home or renter's insurance with the same company. Second, that company will require your underlying policies to have a certain minimum level of liability coverage before they'll sell you the umbrella. For example, they might require you to have at least $250,000/500/100 on your auto policy and $300,000 in liability on your homeowner's policy. This is because the umbrella is designed to sit on top of strong primary policies, not to replace them. Once you have those in place, you just call your agent and ask for a quote. The process is usually quick and painless. So we've covered your core auto insurance. We've covered uninsured motorist protection. And now we've covered the ultimate layer of liability defense with an umbrella policy. You're building a financial fortress piece by piece. But even the strongest fortress has weaknesses. Every single insurance policy in the world has a section that people almost never read. It's the section that details what is not covered, the exclusions, the fine print. And it's in that fine print where some of the most costly mistakes are made. What are the common gotchas, hidden in a standard policy that can leave you completely exposed, even when you think you're doing everything right? We're about to pull back the curtain and expose them. The first and maybe the most common trap is the one involving your friends and family. It's called permissive use. Let's say your friend Sarah is in town and needs to borrow your car to run to the store. You say, "Sure, take my keys." On the way, she gets distracted and rear-ends someone. Who pays? Most people assume your insurance covers it, and they're usually right. Standard policies have a permissive use clause, meaning if you give someone permission to drive your car occasionally, your insurance follows the car, not the driver. So, in this case, your liability coverage would kick in to pay for the other person's damages. But here's the gotcha. What if Sarah isn't just visiting? What if she's your roommate? What if she's your girlfriend who stays over 4 nights a week and uses your car to get to work on Mondays? Now the situation gets incredibly murky. Insurance companies define occasional very strictly. If someone has regular access to your vehicle, especially if they live in the same household, they expect that person to be listed as a driver on your policy. If they're not, and they get into an accident, the insurer can argue this wasn't permissive use. It was regular, unlisted use, and they can deny the claim entirely. Suddenly, you're on the hook for tens of thousands of dollars in damages, all because you didn't add your roommate to your policy. It gets even worse with something called an excluded driver. Let's say your brother has a terrible driving record with a couple of DUIs. To keep your insurance rates from skyrocketing, you sign a form specifically naming him as an excluded driver. This means your insurance company will not cover any accident that happens while he is behind the wheel. One day, there's a family emergency. You've had a couple of drinks, so you ask your brother to drive you to the hospital. He gets into a major accident on the way. The result? Absolute financial ruin. There is zero coverage. Not for the damage to your car, not for the other person's car, not for any injuries. By signing that exclusion, you created an ironclad guarantee of no coverage, no matter how dire the circumstances. It's a ticking time bomb in your policy that many people use to save a few bucks without realizing the catastrophic risk. The second major gotcha is the business use exclusion. This has become a massive issue in the age of the gig economy. You decide to make some extra cash driving for Uber, Lyft, or delivering for DoorDash. You're using your personal car, covered by your personal auto policy. You're on your way to pick up a passenger or a food order, and you cause an accident. You file a claim with your insurance company. The first thing they'll ask is, what were you doing at the time of the accident? If you tell them the truth, that you were working for a rideshare or delivery service, your claim will be denied instantly. Your personal auto policy is priced and designed for personal use only. Commuting to a 9-to-5 job, getting groceries, going on road trips. The moment you turn your car into a tool for commerce, you are engaging in business use, which is explicitly excluded from almost every standard policy. The insurance company sees it as a much higher risk. You're driving more miles in unfamiliar areas under time pressure, and they did not agree to cover that risk. To be properly covered, you need a commercial auto policy or, at the very least, a special rideshare endorsement added to your personal policy. Millions of Americans are driving for these services right now, completely uninsured, and they have no idea. One fender bender could not only get their claim denied, but could also lead to their entire policy being canceled for misrepresentation. Next up is the most pervasive myth in the entire industry: the idea of full coverage. People say it all the time. Don't worry, I've got full coverage. Here's the hard truth. Full coverage does not exist. It is not a real insurance product. It's a slang term that has been so overused that people believe it's an official category. Usually, when people say they have full coverage, they just mean they have the big three: liability, collision, and comprehensive. And while that's a good foundation, it is by no means full. It's more like a house with walls and a roof, but no windows, doors, or plumbing. Let's see what's missing. You get into a bad accident, that's your fault. Your car is totaled and will be in the shop for 3 weeks being assessed and repaired. How do you get to work? Your full coverage policy doesn't include rental reimbursement unless you specifically added it. So you're paying for a rental car out of pocket that's hundreds, maybe thousands of dollars. Or let's say you bought a brand new car for $30,000. A year later, you still owe $28,000 on your loan, but the car's depreciated market value is only $22,000. Someone runs a red light and totals it. Your collision coverage pays you the actual cash value of the car, $22,000. You hand that check to your lender, but you still owe them $6,000 for a car that no longer exists. You're now making monthly payments on a ghost. This is where gap insurance comes in, which covers that gap. But it's not part of standard full coverage. You have to buy it. The term full coverage gives a dangerous, false sense of security, leading people to believe they're protected from every angle when in reality, their policy is full of holes. Here's another one that bites car enthusiasts. You love your car. You've spent thousands upgrading it. You've put in a $1,500 sound system, $2,000 custom wheels, and a $3,000 vinyl wrap. It's your pride and joy. Then one morning you wake up and it's gone stolen. You file a claim with your insurance company, confident that your comprehensive coverage will take care of it. The adjuster comes back with an offer based on the value of a bone stock model of your car. All that money you poured into it? It's gone. It's worth zero in their eyes. Why? Because a standard policy is designed to cover the vehicle as it came from the factory. It does not cover aftermarket parts or custom modifications unless you have a specific add-on, often called a custom parts and equipment, or CPE endorsement. Without that endorsement, your insurance will pay to replace your stolen car with another factory spec model, not the personalized masterpiece you spent years building. Every dollar you put into custom parts vanishes unless you explicitly tell your insurance company about them and pay a little extra to have them covered. Finally, there's a sneaky clause hidden in the fine print of every single policy: the duty to cooperate clause. After you file a claim, you are contractually obligated to cooperate with your insurer's investigation. This sounds simple, but it's a trap. Some people, after an accident, think they're being smart by being secretive. They ignore the adjuster's calls. They refuse to give a recorded statement about what happened. They delay taking their car to an approved shop for an estimate. They think they're protecting themselves, but what they're actually doing is violating the terms of their own insurance contract. The duty to cooperate clause gives the insurance company the right to deny your entire claim, even a perfectly legitimate one, if you obstruct their investigation. Being dishonest, changing your story, or simply being unresponsive can be grounds for a denial. They don't even need to prove your claim was fraudulent. They just need to prove that you failed to cooperate. You paid your premiums for years, you had a valid claim, but because you ghosted your adjuster for 2 weeks, you get nothing. It's a procedural technicality that can cost you everything. These are the landmines hidden just beneath the surface of a standard policy. They are the reasons why two people with seemingly identical coverage can have wildly different outcomes after an accident. But knowing about the traps in the policy document is only half the battle. The other half is navigating the claims process itself. What happens when you actually have to call them? What are the magic words to say, and the forbidden phrases to avoid? When you're on the phone with an adjuster, there is one sentence, one common, innocent-sounding sentence, that people say all the time after an accident, and it can single-handedly give an insurance company the justification to slash your payout by thousands. What is that sentence? And how do you make sure you never, ever say it? That sentence is 2 simple words. 2 words that are so ingrained in our culture as a sign of politeness, of empathy, of being a decent human being, that we say them on autopilot. But at the scene of an accident, they are financial poison. The sentence is, "I'm sorry." That's it. I'm sorry. You bump into someone in the grocery store, you say, "I'm sorry." You accidentally cut someone off in conversation, you say, "I'm sorry." It's a reflex. But when your car has just collided with another, and you get out shaken and full of adrenaline and you say, "Oh my gosh, I'm so sorry," you haven't just been polite. In the cold, calculating world of insurance claims and liability law, you may have just admitted fault. You've handed the other driver's insurance company a golden ticket. They will take those 2 words, twist them from an expression of human sympathy into a legal admission of guilt, and use them to argue that you are responsible for the entire incident. It doesn't matter if the other driver ran a red light. It doesn't matter if they were texting. Your "I'm sorry" becomes the centerpiece of their case against you, potentially costing you thousands of dollars, raising your premiums for years, and even jeopardizing your claim altogether. So the first rule of any accident is to fight every natural, polite instinct in your body and never, ever say "I'm sorry," or anything like it. Don't say "it was my fault." Don't say "I didn't see you." You must be a robot of pure facts. But what do you do instead? The moments after a car accident are a chaotic blur of adrenaline, fear, and confusion. Your heart is pounding, your hands are shaking. This is when mistakes are made. But this is also when your financial future for the next several years can be decided. You need a playbook, a simple step-by-step checklist to run through that protects you, your health, and your wallet. So let's build that playbook right now. Step 1. Secure the scene, secure yourself. Before you even think about insurance, you think about safety. Are you hurt? Are your passengers hurt? Check yourself for injuries. Adrenaline can mask pain, so be thorough. If anyone is seriously injured, your first and only job is to call 911 and report injuries. Don't move them unless there's an immediate danger, like a fire. If the cars are in a dangerous spot like the middle of a highway, and they are drivable, move them to the shoulder. If you can't, turn on your hazard lights immediately. Your life is more valuable than any piece of metal. Step 2. Call the police. Always. I don't care if it's a tiny fender bender in a parking lot and the other driver says, "Hey, let's just handle this between ourselves." No. You call the police. Why? Because a police report is an official, third-party, unbiased account of the incident. When you file a claim, your insurance adjuster and the other driver's adjuster are going to be looking for objective evidence. A police report is the gold standard. Without it, the accident becomes a he said, she said situation, and those rarely end well for anyone. When you call 911, be calm and clear. State your location, that there's been an accident and whether there are injuries. Don't volunteer details about who was at fault, just the facts. Step 3. Become a detective. Your smartphone is now the most important tool you own. You are going to document everything. And I mean everything. Before the cars are moved, if it's safe to do so, start taking pictures. Don't just take one picture of the dent in your door. You're building a complete visual story of the entire scene. Start wide. Take pictures of the entire accident scene from multiple angles, showing the position of the cars relative to each other and to the road. Capture any traffic signs, stoplights, or lane markings. Is it a four-way stop? Was the sun glaring? Is the road wet? These details matter. Then move in closer. Take pictures of the damage on both cars. Not just your own. Get close-ups of every single scratch, dent, and broken part from various angles. Why their car too? Because this documents the full extent of the impact. If they later claim their whole front end was destroyed, but your photos only show a minor bumper scrape, you have proof. Now get the specifics. Take a clear photo of the other driver's license plate. Take a photo of their driver's license and a photo of their insurance card. This prevents them from giving you false information. Also, find the VIN, the vehicle identification number. It's usually on a small metal plate on the driver's side dashboard, visible through the windshield. Take a picture of it. This confirms the exact vehicle involved. Finally, if there are any witnesses, people who saw what happened, ask them politely if they'd be willing to give a statement to the police or provide their name and phone number. Independent witnesses are incredibly powerful in a claim dispute. Step 4. The information exchange. This is where you talk to the other driver. Remember rule number 1. You do not apologize, you do not admit fault. You are polite, but you are firm. You stick to a script. The only things you should say are phrases like, "Are you okay?" And "We need to exchange information." You need their full name, address, and phone number. You need their insurance company name and their policy number. You need their driver's license number. And you need the make, model, and year of their vehicle. You give them the exact same information about yourself. Do not discuss the accident itself. If they start yelling or trying to blame you, do not engage. Just say, "The police are on their way, and we can let them sort it out." Be a broken record. Calm, collected, and non-confrontational. Step 5. Talking to the police. When the officer arrives, let them lead the conversation. They'll ask you what happened. This is not the time for a dramatic story. This is the time for simple, objective facts. Do not guess, do not speculate, do not assume. If you say, "Well, he came flying out of nowhere," that's a subjective opinion. Instead say, "I was traveling east in the right lane. The light was green. I then felt an impact to the rear of my vehicle." See the difference? One is an emotional reaction. The other is a statement of fact. Stick to what you know for sure. If you don't know the answer to a question, say, "I'm not sure," or "I don't recall." That is a perfectly acceptable answer. It is far better than guessing and being wrong. Once the officer has taken your statement, ask for their name, badge number, and the police report number. You will need this to get a copy of the report later. So let's recap the playbook. 1. Safety first. 2. Call the police always. 3. Document everything with your phone. 4. Exchange information calmly, without admitting fault. 5. Give the police objective facts only. Following these 5 steps creates a protective bubble around you. You've avoided the catastrophic mistake of admitting fault. You've gathered ironclad evidence to support your version of events. And you've secured an official police report to back it up. You have taken control of a chaotic situation and laid the perfect groundwork for a successful insurance claim. The police have left. The tow truck is on its way. You're finally sitting in your damaged car. The adrenaline starting to fade, replaced by a deep sense of dread. Now comes the moment of truth. You have to call your insurance company. This single phone call is the next major hurdle. The person on the other end will sound friendly, helpful, and empathetic. But they are not your friend. They are an employee of a multi-billion-dollar corporation, trained to gather information that will minimize their company's payout. They will ask you one simple question. Tell me what happened. How you answer that question, the specific words you choose in that first conversation, can either fast-track your claim for a full payout or send it down a rabbit hole of delays, denials, and disputes. What is the one thing you must never, ever volunteer in that first call? And what are the magic words that shift the power dynamic back in your favor? The one thing you must never, ever volunteer is a recorded statement. Let me repeat that. When that friendly adjuster from the other driver's insurance company calls you, oozing sympathy and concern, and says, "To speed things up, I just need to get your version of events on a quick recording," your answer is a firm, polite no. This is the single biggest trap in the entire claims process. Feels harmless, feels official, feels like you're being cooperative, but you have just walked onto a legal minefield, and the person guiding you is the one who planted the mines. That adjuster is not your friend. They are a highly trained professional whose job, plain and simple, is to save their company money. And the number one way they do that is by getting you to say something, anything, on a recorded line that they can use to devalue or deny your claim. Think about it. You've just been in an accident. You're shaken, you're stressed, your adrenaline is pumping, and your memory is fragmented. You're not a trained witness, but the adjuster asks questions for a living. They know precisely how to phrase things to get you to second-guess yourself, to speculate, to accidentally contradict the police report, or to downplay your injuries. They'll ask, "So where were you looking right before the impact?" You might say, "Well, I was checking my side mirror for a second." Boom. On a legal recording, that can be twisted into, "So you admit you weren't looking at the road ahead." They'll ask, "And how are you feeling?" You, trying to be tough or polite, might say, "Oh, I'm okay, just a little sore." Boom. That recording will be Exhibit A when you later need physical therapy for debilitating whiplash. They will argue that your injuries couldn't have been that serious if you said you were okay just hours after the crash. This recorded statement is not for your benefit. It is a tool for them to lock you into a story before you've had time to process the event, review the police report, or even understand the full extent of your injuries. It's a deposition where you have no lawyer, no preparation, and no idea what the other side is looking for. Giving one is like handing the opposing team your entire playbook before the game even starts. So, what are the magic words? How do you refuse without sounding uncooperative and hostile? This is where you shift the power dynamic. When they ask for that recorded statement, you take a breath and you say calmly and clearly, "I am not providing a recorded statement at this time. However, I am happy to cooperate fully. I will provide you with a written statement and all the necessary documentation, including the police report number, once I've had the chance to organize it." Let's break down why this is so powerful. First, you've politely but firmly declined their request. You've taken control. Second, you've stated your intention to cooperate fully, which prevents them from labeling you as difficult. Third, and most importantly, you have moved the entire conversation from their turf to yours. A phone call is immediate, uncontrolled, and designed to catch you off guard. A written statement is the opposite. It's deliberate. You control the time, the place, and the exact words used. You can write it after the shock has worn off. You can review it for accuracy. You can stick to the pure, unassailable facts without adding emotional filler or speculation. You are no longer reacting to them. They now have to wait for you. The power has shifted. Your written statement should be a sterile document. It is not a novel. It is a list of facts. Date, time, location. Weather conditions. What you observed using neutral language. My vehicle was proceeding northbound in the right lane. The other vehicle entered my lane of travel from the west. Do not say, "This maniac came screaming out of a side street and slammed into me." Stick to the facts. The police report and the evidence will tell the story. Your job is to not give them any ammunition to twist. This brings us to the second most dangerous phrase you can utter, not just to the adjuster, but to anyone at the scene. I'm fine. Never ever say I'm fine. Adrenaline is a powerful anesthetic. It can mask serious injuries for hours, even days. Whiplash, concussions, and internal injuries often have delayed symptoms. You might feel a little stiff at the scene, only to wake up the next day unable to turn your head. If the adjuster on that first call asks how you are, your answer is not "I'm fine." It's not "I'm okay." The correct and only answer is, "I am seeking a medical evaluation." That's it. It's truthful, it's non-committal, and it protects your right to claim medical benefits if and when you need them. You are not a doctor. Do not diagnose yourself at the scene of an accident or on a call with the claims adjuster. So on that first call, you provide the bare essentials and nothing more. Your name, address, and policy number. The date, time, and location of the incident. The other driver's information if you have it. The police report number. That is it. You are a broken record of facts. When they push for more detail, for your opinion, for how you're feeling, you politely redirect them. That will all be included in my written statement. Or as I said, I am seeking a medical evaluation. From that moment forward, your new best friend is documentation. You are now building a case. Your case. Start a dedicated folder or a digital file. Every single thing related to this accident goes in it. Take more photos than you think you need. Your car from every angle. The other car. The street signs, the skid marks, the debris on the road. Your visible injuries, and take new photos every day to show how they develop. Get a copy of the police report as soon as it's available. Read it carefully. If there are factual errors, contact the police department to see about getting an addendum filed. Create a communication log. Every time you speak with an insurance representative, log the date, time, their name, and a summary of what was discussed. Better yet, try to keep all communication in writing. After a phone call, send a follow-up email confirming what was said. Dear Mr. Adjuster, thank you for the call today. To confirm our conversation, you stated that you would be sending me the forms for the rental car by the end of the day. Please let me know if my understanding is incorrect. This creates a paper trail. A paper trail is your shield and your sword. It prevents them from saying "we never received that," or "that's not what I said." It holds them accountable. And finally, start a journal. Document your physical symptoms. A headache on Tuesday. Neck stiffness on Wednesday. Difficulty sleeping on Thursday. Document how the injuries are affecting your life. You couldn't pick up your child. You had to miss a day of work. You couldn't go to the gym. This isn't about being dramatic. It's about creating a factual record of your damages. Insurance pays for damages. If you don't document them, they don't legally exist. You've now taken control of the information. You've sidestepped their biggest trap, asserted your boundaries, and started building an ironclad file of evidence. You've moved from being a victim of circumstance to the CEO of your own claim. You have played your cards perfectly. But now comes the final boss battle. The settlement negotiation. They're going to slide an offer across the table. And for 99% of people, it's a trap. How do you spot a lowball offer from a mile away? And what's the three-step negotiation tactic that can double, or even triple, their first number? The answer is the difference between getting a check that covers your bills and one that leaves you in debt for years to come. The moment an accident is over, a new clock starts ticking. It's the countdown to the phone call, the one from the other driver's insurance adjuster. They will sound friendly, concerned, even helpful. They are not your friend. They are a highly trained professional whose entire job, whose performance review and bonus, depends on one single metric: closing your claim for the lowest possible amount. They have a playbook and they've run it thousands of times. Today you get their playbook and you get a better one. First, let's expose their strategy. Their opening move is almost always the quick cash offer. Within days, sometimes hours, they'll call you up. We've reviewed the initial details, and we'd like to offer you a check for $2,000 right now to settle this and put it all behind you. Sounds tempting. You have bills piling up, the stress is immense, and quick money feels like a life raft. But it's not a life raft, it's an anchor. They are preying on your shock and your immediate need for cash. They are offering you pennies on the dollar before you even know the full extent of your injuries or the true cost of your vehicle repairs. Cashing that check means signing away your right to any future compensation, even if doctors later discover a serious injury that requires surgery. Their second tactic is the recorded statement trap. The adjuster will say, "I just need to get your version of events on a recorded line for our records." It sounds routine. It is a calculated interrogation. They will ask leading questions designed to get you to downplay your injuries or accidentally admit partial fault. "So you were feeling okay right after the crash? You didn't see the other car until the last second?" Every hesitation, every slightly inconsistent detail can be twisted and used against you to devalue your claim. The rule is simple. You are under no legal obligation to give a recorded statement to the other party's insurance company. Politely decline. And if those don't work, they resort to the delay and wear down strategy. They'll go quiet. Your calls go to voicemail. Emails go unanswered. Weeks turn into months. They know you have bills to pay. They know the pressure is mounting. They are waiting for you to get desperate enough to accept their original lowball offer. It's a war of attrition, and they have all the time and resources in the world. But now it's our turn. Here is the 3-step negotiation tactic that flips the script and puts you in control. Step 1 is building your fortress. You don't go into battle without armor. And in an insurance claim, your armor is documentation. Every single piece of paper is a stone in your fortress wall. First, the police report. Get a copy immediately. It's the official, unbiased narrative. Next, photos and videos. You should have taken them at the scene, but also take photos of your injuries as they heal, documenting the bruises, the cuts, the cast. This is powerful visual proof. Then every single bill. Not just the big ones. The hospital visit, the ambulance, the physical therapist, the chiropractor, the prescription for pain medication, the receipt for the crutches, even the mileage to and from your doctor's appointments. Every single cent is a quantifiable loss. You need proof of lost wages. Get a letter from your employer stating your pay rate, your normal hours, and exactly how many hours or days you missed due to the accident and your injuries. If you use paid time off, that counts too. That was your time and the accident forced you to spend it. Now get at least 2, preferably 3 independent repair estimates for your vehicle from reputable body shops. This prevents the insurer from claiming your chosen shop is overcharging. And finally, the most important document you will create. The pain and suffering journal. Every day, write down a few sentences. Woke up with a sharp pain in my neck. Couldn't turn my head to the left. Had to ask my partner to help me get dressed today. Missed my son's soccer game because I couldn't sit in the bleachers for that long. This journal transforms your pain from an abstract concept into a concrete, day-by-day reality that is impossible to ignore. This fortress of documentation is your foundation. Without it, you have nothing to stand on. Step 2 is launching your first strike. The demand letter. This is where you stop being reactive and start being proactive. You are no longer waiting for their offer. You are making your demand. A demand letter is a professional, organized document that lays out your entire case. It doesn't have to be full of legal jargon. It needs to be clear, factual, and backed by the fortress you just built. It starts with a concise summary of the facts, the date, time, and location of the accident, and a clear statement of why their insured driver was at fault, referencing the police report. Next, you detail your injuries and the medical treatment you've received. Then comes the most critical part, the math. You create a bulleted list of all your special damages, also known as your economic losses. This is every single bill and lost wage you documented. You add it all up to a specific number. Let's say your medical bills, car repairs, and lost wages total $10,000. Now you address the general damages, your pain and suffering. This is where your journal becomes your weapon. You write a paragraph or 2 describing how the injuries have impacted your daily life, using specific examples from your journal. How do you put a number on that? The most common method is the multiplier. You take your total special damages, that $10,000, and you multiply it by a number typically between 1.5 and 5. The more severe, painful, and long-lasting the injury, the higher the multiplier. For a minor whiplash that resolves in a few weeks, you might use a 1.5 or 2. For a broken bone requiring surgery and months of rehab, you might argue for a 4 or 5. Let's say you choose a multiplier of 3. $10,000 in special damages times 3 equals $30,000 for pain and suffering. You add that to your original $10,000. Your total demand is $40,000. This isn't a random number you pulled from thin air. It is a calculated figure based on evidence. You end the letter by stating your total demand and including copies of every single document from your fortress. You send this entire package via certified mail so you have proof they received it. Now step 3, the negotiation dance. The ball is in their court. They can't ignore a formal demand letter. The adjuster will call you. They will not offer you $40,000. They will come back with a counteroffer. It will be low. It might be $15,000. This is the moment of truth. Most people panic. You will not. Your first response is always the same. You say, calmly and politely, "Thank you for the offer, but that's simply not in the ballpark of what we need to resolve this claim, especially given the extensive documentation I've provided. Can you please explain how you arrived at that number?" You have just done 2 brilliant things. You rejected their offer without being emotional, and you've put them on the defensive. You've forced them to justify their lowball number against your mountain of evidence. They can't. They'll mumble something about industry standards or typical settlements. You hold your ground. You don't immediately drop your number. You reiterate the facts. Well, as my documentation shows, my medical bills alone were X, my lost wages were Y, and the impact on my daily life, as detailed in my journal, justifies the multiplier we used. You are not arguing. You are referencing your evidence. This is a business transaction. The dance continues. They might raise their offer to $20,000. You might, after a day or two, come down to $37,000. You never split the difference. If they are at 20 and you are at 40, don't offer 30. That shows you're too eager. You make small, calculated moves, and with every move, you refer back to a piece of evidence. Given the projected cost of my future physical therapy, the lowest I can consider at this time is $37,000. Patience is your ultimate weapon. Be willing to be silent on the phone. After you state your position, stop talking. Let them fill the silence. They are on a schedule. They need to close your case. You are on your own schedule. The one who is most comfortable with silence often has the most power. Eventually, you will reach a number that is fair and that you can live with. It will almost certainly be double or triple their initial, insulting offer. When you agree on a number, do not sign anything until you receive the settlement agreement in writing and have read every single word. This entire process, from building your fortress to the final handshake, is how you level the playing field. It's how you transform from a victim into an advocate for yourself. Insurance isn't just a piece of paper you keep in your glove box. It's a system. And like any system, it can be navigated and it can be won. By understanding the rules, by preparing for the fight, and by advocating for what you are rightfully owed, you ensure that if the worst day of your driving life ever happens, it won't be followed by years of financial hardship. You've now got the knowledge. You have the playbook. You are prepared. Drive safe.